Okay, let's jump right into the material. Welcome back to this deep dive, where today we are unpacking the Q3 2025 earnings call for Kinder Morgan. That's KMI.
And our mission, as always, is to sift through the management commentary, the financials, all of it, and really find the core story. And with KMI, the story is pretty compelling right now.
It seems to be. They're this massive energy infrastructure giant, and they're basically arguing they're at the center of some huge kind of unexpected shifts in U.S. energy demand.
Exactly. So just to set the stage, KMI runs the largest natural gas pipeline network in North America, and this quarter's results, well, they really leaned into that dominant position.
So let's start there. The headline numbers. What's the snapshot look like for Q3?
The snapshot is optimistic. I mean, they delivered strong results, and they're now saying they expect to beat their own full-year budget for 2025.
And what's the key metric? For a company like this, it's all about cash flow, right?
Right. So adjusted EBITDA, that's the big one. It grew a really robust 6% year over year. For a company this size, that's a very healthy clip.
Okay, and did that translate down to the bottom line?
It did, yeah. Adjusted earnings per share showed some really impressive double-digit growth. It was up 16% year over year.
16%, wow.
Yeah. Net income came in at $628 million, which gives you about 28 cents per share. And for their investors, the dividend is key. They bumped that up too.
He saw that, 29.25 cents a share for the quarter.
Which annualizes to about 117. That's a 2% increase over 2024. So you're getting both stability and growth.
So what was the driver? What did management point to and say, this is why we're winning?
It was, a mix of things. Good execution on their part for sure. New expansion projects coming online, the recent Outrigger acquisition helping out. But really, the big one was just rock solid, robust demand across their entire natural gas footprint.
And that leads right into the main event of the call, doesn't it? They spent most of their time looking forward, talking about the structural story.
That's right. They're making a multi-decade bet here. And they laid out two specific, just massive long-term drivers for natural gas demand.
Okay, so let's dig into those. What's driver number one?
Driver number one is the one we've been hearing about for a while, but the scale is still staggering. It's the LNG export expansion.
Right. The U.S. sending gas all over the world.
Exactly. And the industry consensus, which they quoted, suggests that the amount of gas needed for these export terminals, the feed gas, is going to at least double between 2024 and 2030.
Double. That's an incredibly aggressive growth rate for a commodity this huge.
It's wild. One estimate they cited projects a 130% increase. That translates to something like 31 to 32 billion cubic feet per day.
Just for context, how fast is that happening right now?
Very fast. In 2025 alone, 6 major LNG projects hit what's called final investment decision. That's the green light. And just those 6 projects represent 9 BCF per day of future demand.
And KMI is positioned to basically be the toll road operator for all of that.
Yeah, pretty much. They already transport over 40% of all U.S. natural gas, and that includes over 40% of the gas heading straight to those LNG facilities. So they are right in the middle of it.
Okay, that makes sense. But the second driver, that's the one that feels newer, almost like a surprise catalyst. AI and data centers.
Absolutely. This was the really interesting part. The second driver is this incredible surge in demand for electricity to power these massive, always-on AI data centers.
And management's argument is that you can't just build more solar farms to cover this.
That's the core of their argument. They say the sheer scale of the new electricity load just can't be met by scaling up renewables like solar and wind alone.
Okay, but why not? I mean, that's a counter argument, right? We hear all the time about cheaper renewables, better batteries. Is this just KMI talking up their own book?
It's a fair question, and they actually addressed it directly with some pretty specific logistical points. They argue the alternatives are just impractical for the kind of 247 power these centers need.
Okay, so break that down for us. What's the problem with renewables and batteries?
Well, first, pairing renewables with utility-scale batteries is still extremely expensive. And, batteries are great for a few hours, but these data centers need power that can run for days on end during a weather event. The duration is a huge issue.
And there's a space issue too, right?
A massive one. Management did the math. They said for 1 gigawatt of continuous solar power, you need 5,000 football fields of land. And that's before you add the land for the battery storage.
Wow. Okay. And what about the other big one? Nuclear.
Too slow and too risky from a capital perspective. A new nuclear plant, they said, takes 7 to 10 years to build. The AI companies need the power now.
So the conclusion is that natural gas is the only thing that can fill that gap quickly and reliably.
That's their bet. It's abundant, it's reasonably priced, and the infrastructure can be built relatively quickly. So they see gas capturing a huge slice of this AI-driven power demand over the next decade.
And again, KMI is already there, transporting 25% of the gas that fuels U.S. power plants today.
Exactly. They're already embedded in the solution.
This really does sound like a massive structural tailwind for them. So let's pivot. How are they planning to actually monetize all this demand? Let's talk about the investment pipeline.
Okay, so this is where we look at their project backlog. The sanctioned projects, the ones they've committed capital to, that backlog is strong and holding flat at $9.3 billion.
Well, that doesn't sound exciting. Is that a good thing?
In this case, yes. It's flat because as they finish projects and put them into service, they're replacing them with new ones. It shows a healthy, continuous cycle of development, and they're still being disciplined, targeting returns below a 6x multiple.
Okay, so that's the official sanctioned backlog. But you mentioned something called a shadow backlog before we started. That's a fascinating term. What is that?
Yeah, the shadow backlog is their term for the opportunity set. These are projects they are actively pursuing with customers but haven't officially sanctioned yet. And that pipeline is now over $10 billion.
So bigger than their actual backlog.
Bigger than their actual backlog.
Yeah.
And management's point was that this level of opportunity is what they were seeing back when their sanctioned backlog was only $3 billion. It just signals how robust the demand environment is.
It's all focused on natural gas, I assume.
Yeah.
LNG power, Mexico.
Overwhelmingly. And it's spread out geographically, projects from Arizona all the way to potential work in Florida. It's not concentrated in one spot.
Let's get into the operational proof. Where are we seeing this strength show up in the numbers right now?
You look right at the natural gas segment. Transport volumes were up 6% year over year. That was mostly driven by more deliveries to LNG plants through their Tennessee gas pipeline.
TGP, right?
And also more gas from the Permian heading south to Mexico. It's really a continental system firing on all cylinders.
What about even further upstream? The gathering systems that connect directly to the wells.
Good question. Gas gathering volumes were up 9% year over year. And even more telling, they saw an 11% sequential jump. That's producers ramping up production in real time to meet this LNG pull.
And they singled out one basin in particular, right? The Haynesville.
They did. The Haynesville system is approaching new daily volume records. They've poured $500 million into that system, treating capacity pipelines just to handle the volumes their customers want to move.
And why is Haynesville so important right now?
Because it's projected to be one of the fastest growing basins in the country. They're expecting it to grow by almost 11 BCF per day between now and 2030. KMI invested ahead of that boom, and now they're starting to see the payoff.
We spent a ton of time on gas, and for good reason. That was management's focus.
Yeah.
But for balance, were there any weak spots? Any segments that didn't perform as well?
Yeah, there are a few. The CO2 segment saw lower oil production and lower CO2 volumes, and their refined products volumes were down just a tick, about 1% year over year. And management also admitted that their overall beat would have been even bigger if not for lower prices for renewable energy credits RENEMs and some weaker volumes in their renewable natural gas or RNG business.
So the green assets were actually a small drag this quarter. That's interesting.
It is, yeah. A little bit of an ironic twist.
Okay, shifting back to strategic projects, they announced a big new one in that refined product segment, the one that was a little weaker. Tell us about the Western Gateway Pipeline.
Right. This is a major JV with Phillips 66. They're launching an open season for what they're calling the Western Gateway Pipeline. And the key piece here is that it involves KMI reversing its existing West line.
A reversal. Why is that a big deal?
Because it lets them move refined products like gasoline and diesel from the huge refining center in Texas westward into major markets like Arizona, California, and Vegas.
So it's about supplying growing markets and backfilling declining ones, like California with its refinery closures.
That's it, exactly. It's an elegant solution. They're not building a massive new pipeline from scratch. They're leveraging an existing asset with some smart engineering to capture a market shift.
Which sounds very capital disciplined.
Very. KMI's capital contribution is actually smaller than P66's because they're just contributing existing assets and the reversal cost. The final JV split will be around 50-50, and they're targeting a 2029 in-service date.
Okay, let's bring it all home and check on the engine room, the balance sheet. Can they actually afford this $9 billion backlog and this $10 billion shadow backlog?
They spent a lot of time on this. They stress their discipline repeatedly. Net debt to adjusted EBITDA is now down to 3.9 times from 4.1.
And the ratings agencies noticed that.
They did. Fitch upgraded their senior unsecured rating to BBB plus stack. That's a real validation of their strategy to delever.
And they got a little help from Washington, too, on the tax front.
A big help, yeah. The recent budget reconciliation bill gives them meaningful tax benefits, mostly from being able to fully expense their investments.
And there was something about the corporate alternative minimum tax.
Right. Adjustments there are expected to provide, and this is a quote, additional investment capacity starting in 2026. Basically, it's a tax tailwind that frees up more cash for them to build.
So they have the demand, they have the projects, and now they have the cash flow and the tax benefits to fund it all.
Absolutely. They have about $2.9 billion in free cash flow after they paid a dividend. They were very clear that even if their CapEx has to go above $3 billion a year in, say, 2027 or 2028, they can self-fund it without straining the balance sheet.
So the big takeaway for you, the listener, is this. You have a massive, multi-decade structural tailwind in natural gas. It's driven by LNG exports and AI power needs. And it's being met by this well-capitalized company that's using its existing assets and new tax breaks to fuel disciplined growth. That's a really powerful combination. Which, of course, brings us to our favorite part of the deep dive, the not financial advice segment, where we cook up one outrageous but plausible trade idea based on the core themes from the call.
And the core tension here is definitely that debate over power generation for AI. KMI is making a huge bet that natural gas is the only reliable 204th of a solution that can be deployed right now.
A bet on logistical reality winning out over maybe policy hopes. So set the scene for the trade.
Okay, the trade is a multi-leg relative value play. It's designed to profit if KMI's AI thesis proves correct in the near to medium term.
I'm ready. Lay it on us.
The action is you go long KMI, the reliable gas infrastructure provider, and you pair that with a short on a basket of high-growth, pure-play industrial battery storage companies, or maybe some utility-scale solar developers, the ones with really aggressive valuations.
So you're betting that the immediate, overwhelming power needs of AI will force utilities to pick the fastest solution gas, which in turn slows down the capital flowing into the renewables and storage sector.
Precisely. You're betting that this AI power crunch creates a preference shock. It delays the mass adoption of utility-scale batteries that these renewable pure plays are banking on for their high growth rate.
So KMI transports the fuel that solves today's problem. And the short position captures the idea that the ideals of the energy transition might hit a speed bump because of this overwhelming immediate need.
That's the trade. It captures KMI's thesis on AI power reliability in a single hedged position. Now, I have to say this very clearly.
Yes.
This is entirely speculative. It is not financial advice. Please consult your own professional advisor before you even think about making any investment decisions.
Absolutely. So to recap the critical takeaways for you, KMI is beating its budget, and it's all being driven by the natural gas segment. LNG exports and AI data centers are the twin engines of growth, underpinning their $9.3 billion backlog and that $10 billion plus shadow pipeline.
And their balance sheet is strong and getting stronger, positioning them to fund all of this growth themselves.
Which brings us to our final provocative thought for you to chew on.
Management mentioned that the regulatory environment for building pipelines seems to be getting a little bit more supportive after years of being really tough. So the question is, if the trend of quicker FERC approvals continues, how much bigger can that $10 billion shadow backlog get by the end of 2026? It suggests that the pace of their capital deployment might actually speed up faster than the market is expecting right now.
An excellent thought to end on. Thank you for tuning into this deep dive, and we encourage you to continue exploring this fascinating intersection of energy, infrastructure, and technology.